From the vantage point of the monetary metals, I don't think what the Fed does matters other than they continue to decay the value of the money unit, meaning they expand the money supply. I don't just mean the Fed, but the Bank of Japan, your EU, et cetera, they all print money like crazy. And there's always an excuse to do it. And sometimes those excuses create more acceleration in the monetary expansion. And I've heard lately, just for example, like in November, President of the New York Fed, Williams, said, we're going to start buying T-bonds. Okay? And it was only for the purpose of providing liquidity, was his excuse. Well, T-bond prices have oozed down consistently since then. Yields have gone up. We made a new low monthly price close for T-bond futures going back 20 years, meaning a new high monthly close on yields. And they're very concerned about the government debt market. So what's going on in Japan is starting to go on here, meaning a government debt crisis, not a mortgage crisis, not a bust of the dot-com or anything like that, but something far bigger than any of those so-called fundamental events. If you go back in history and look at Fed funds rates and ask the question, well, does the rise or fall in Fed funds rates affect gold? The answer is zero. No, there was no correlation. Go back to the late 70s, stock market was a wasteland. Global stagflation we had. Okay. Yields exploded. The Fed raising rates all the time. It was berserk. It was like 14%. Same with long-term debt markets, long-term bond market. The yield was rising. Gold exploded during that time. People forget that. And there are plenty of other times where the Fed will cut rates and not have the effect on gold or the stock market as it's expected to have. And I think we're in one of these crisis modes right now where the big issue is not AI or, the semiconductors had a huge spill or something like that. It's a government debt crisis. Mm-hmm. It is far bigger in asset category size than the U.S. stock market. And it's not just Japan now, it's us. We're not talking about Guinea or some third world country. Okay. So that is not a topic of major front page conversation on the financial.
No,
it's not. And you turn on the financial channels, they're not chattering about that. They're talking about earnings of some AI company or whatever. I think that's a huge event. And that is the fundamental driver right now of monetary metals, is the awareness that the fuel that drives them up over the decades, the degradation in the money unit, is going to continue and increase. And the Fed just recently did what? They went in to help save the yen.
Yeah.
Billions and billions. Now, why? Because the Japanese have to dump our bonds to have liquidity. Mm-hmm. And they don't want them to do that. So we're defending our bonds by supporting the yen. It's just really an interesting situation, yet it's not a headline topic.
In August 2026, Japan and the United States ran their first coordinated currency intervention in decades to prop up the yen, officially framed as an effort to calm disorderly trading, but widely read by analysts as a move to stop Japan from dumping U.S. treasuries to defend its own currency instead. The sequence is telling. Japan needs liquidity, its natural move is selling off U.S. debt, and Washington would rather step into currency markets than let that selling hit treasury prices even harder. The dollar index itself, weighted more than 70% toward the euro and yen, has stayed deceptively steady, masking the real strain building underneath in the bond markets both countries depend on.
I suspect he sees it and is not ignoring it, but he can't talk about it. Yeah. Because if he does, he brings it to the forefront and creates panic. So he has to keep focused on the quote, mandates. Mm-hmm. And by the way, those mandates are not something to watch if you're looking at the stock market, because we did a study a few months ago showing the correlation, or the non-correlation, between unemployment rate getting dark and the stock market topping. The stock market always tops and is seriously off its high before then you start to see that data point, that mandate, suddenly give the Fed an excuse to cut. And once they start cutting, go back and look, 2000, 2002, 2007 to 2009. They cut in a rampage, cut rates. Did it help the stock market? No. And so what were you left with at those times when you needed an alternative? Well, you had T-bonds and you had gold. They both did well during those years. Now suddenly, oops, not so sure about T-bonds anymore. Like the CIO of Morgan Stanley said months ago, it's no longer 60-40 rule, stocks, bonds. It's now 60-20-20, bonds and gold. Hell of an admission. Okay. A lot of things are going to change, not just that, but a lot of perceptions about what ought to be and what's been around for so long that we think it's there forever are going out the window when this event unfolds rather. It's already occurring. The dollar is an interesting situation that too many people pay attention to for short-term assessment about, gold's down today because the dollar was up today. First off, the dollar that people quote is the dollar index. And if you examine what's inside that index, it's over 70% euro and yen, period. And then a couple other major currencies comprise the rest 30%. But it's the recent firmness in the dollar, rather steadiness, because it dropped hard from 2025 down to this year and has gone sideways for about a year now. And we had a recent rally, but all that was due strictly to the yen component of the dollar index. The euro is quite stout over the last couple of years. It had a drop recently too, but it's quite steady. It's primarily a yen function that kept the dollar index steady. And also, if you go back to when gold made a low, major bear low, in December of 2015, gold was $1,050. The dollar index at that time was trading about 97 to 98. You know where the dollar index is right now? 99. So you say, well, it's been sideways, therefore, for 11 years now. Gold should be sideways too, right? No, gold's 4.5-fold. Okay, above. So sometimes that is a factor, the dollar index, and we argue technically that it is prime now for the major downside, like to go back to where it was a couple decades ago at around 70 on the dollar index, which would mean what you just said, and that is it's no longer the global reserve currency. And I think the perception will rise during this next year or so, probably within the next handful of months. Gold is money. Yeah. It's always been money for thousands of years. So is silver, by the way.
I was going to ask you about silver.
Yeah, and therefore, who has acknowledged that? Certainly not the Western powers, not Japan, not Europe, not the U.S. The Chinese have. Strange world, but they've acknowledged that it's real money. So that it's going to be an interesting factor. And the dollar index decline, which I expect to see significant, will play into this mix, but it's really not a causal factor. It's reflective, and it's also a distorted index.
Gold's price action tends to run ahead of the news cycle rather than react to it. When gold bottomed near $1,050 an ounce back in December 2015, the dollar index was sitting around 97 to 98, almost exactly where it's trading today. And yet gold has since climbed roughly fourfold, hitting an all-time intraday peak near $5,589 in January 2026, before settling into the $4,300 to $4,400 range by mid-August. Strategists increasingly frame this less as a gold rally and more as evidence of currency erosion. Money supply growth has outpaced official inflation readings for years, and gold has tracked that broader monetary expansion far more closely than consumer price indexes ever managed to capture.
The silver and the gold and silver miners, the babies of the mama market gold, are going up far more dramatically over the next handful of months and possibly a year or so due to these events we've been chattering about, they know what's going on. And I think silver, after actually a 2-day break that occurred the last day of January, the first trading day of February this year, where most of the break was over at that point, amazing drop. You've had multiple rally efforts by silver and gold that don't seem to sustain. and they come back down and they nip out the low again. They don't really go much further, but they nip out the prior low to scare people, go up again, then nip out the prior low. They've done it 3 times, Feb low, then the March low, and then a recent low. The upturn we've seen last week when silver was moving up towards 60, via our momentum technical metrics, argue that this rally is different than those 2 prior ones. Okay. This one will sustain, and this one will move that market, gold and silver and the miners, up and out of this ink that has persisted for 6 months. And what's on the other side of that, I'm not going to put targets out anymore.
Okay.
We had long ago mentioned that 300 to 500 would be a fair value for silver based on a lot of factors, not merely our technicals, but think about this for a minute. If you looked at the price of, I wrote them down here, lead, steel, zinc, aluminum, copper, gold, and went back to 1980, they were all pretty strong then. They had a big move. Gold peaked in 1980 at $850, for example. Copper, lead, all these base metals hit a high level, and then they plateaued. Silver remained in a 50-year plateau, while these metals are now trading 4 and 5 times that price level of 1980. How come silver is only 16 cents right now above its 1980 high? Something weird is going on there. Now, there have been arguments that have validity that it's been manipulated, and if so, I'm going to say that won't sustain. Reality ultimately wins, and if you're in the way of reality, you can get killed.
Yep.
Now, if silver were merely to reflect the price gains of copper, lead, zinc, steel, where gold's 4.5 times where it was in 1980, and merely say, oh, I'm going to catch up to you guys. Well, you could do the math. Where would we be? Several $100s. The thing is, though, that gold is not going to stop here. When gold re-engages, silver's going to re-engage too. And when we do an analysis of the relationship between silver and gold, historically, going back decades, what was the price of silver versus the price of gold expressed as a percent? We plot that. And you can see a massive spread chart. We call them spread charts. A base built that was like 10 years wide. We've popped out of it late last year. And the pullback hasn't negated that. Silver in 1980 was 6.5% of the price of an ounce of gold. Right now, silver is like 1.6% of the price of an ounce of gold. Okay? So what if silver were to say, hey, I'm just going to catch up to old valuations? Now, when you go to the gold and silver miners, it knocks your head off because the spread chart that we've shown our subscribers is 12 years wide. In other words, let's take XAU index, which is the Philadelphia Gold and Silver Miners Index. Okay, go back to 1980s. Where was it trading in relation to an ounce of gold? If you divided XAU index into gold, it was either side of 25% of a price of an ounce of gold. It was up to 35 at one time, got down to about 18 one time, but on average for decades, it was a quarter of the price of an ounce of gold. Okay, it dropped to 4% in the bear market in 2015, and still it's only above 8%. So it's still vastly undervalued to that which they get out of the ground, and they're making money like crazy. Anybody who examines the various gold and silver miners would be stunned by that which they would be stunned by if it were some other tech company.
Yeah.
Okay, so we're arguing that what is coming next is not merely that gold's going to resurrect itself into another dramatic leg, but that silver miners, the gold miners, and silver will vastly outpace it.
Silver's 2026 has been a wild ride. After a historic surge to a nominal all-time high near $121 an ounce in late January, a roughly 190% year-over-year gain at the peak, the metal pulled back sharply, spending much of the summer trading in the mid-$50 to mid-$60 range. As of mid-August, it's sitting near $63 to $65, with the gold-to-silver ratio hovering around 67 to 68, well off the extreme lows seen earlier in the year, but still historically favorable to silver relative to the 80-year norm. Some analysts argue silver remains historically cheap next to industrial metals like copper and zinc, which have already multiplied several times over their 1980 price peaks while silver has lagged behind.